can.
Oh, yeah, you got it. Nice.
I guess so. Well, perfect.
Perfect. Okay, good. So the only restriction that you're going to have is that you'll have a 45-minute limit before it will kick us off. So I don't know. I'm sure you'll probably want to jump off and do your thing long before 45 minutes is up anyways. So
yeah, it's all good.
Okay, sweet.
All right.
And then you can also share your screen at the bottom of the Zoom thing. It shows that there's like a share. You can click on share and share your screen too.
Awesome. Okay. Well, I'll do that then, because that way I can share my because I just have my simulated account up. So I'm gonna go ahead and do that then. Share. Here we go. I'll share. Yeah, screen 3 is fine. That one's okay. Good. That's the one I wanted to share. Perfect. Awesome. Okay, so
Hey, there you are.
we're recording. We're sharing. I think we're in business. Awesome. Okay, great.
Perfect.
Well, I'll kick things off. So just real quick, we wanted to go over options today, right? Is that right?
I mean, you're more than like whatever you're already planning on working on is fine. I think that it would be great if we could eventually have a video on both. But since it's just you and me, especially, just do whatever you already had planned or whatever is more beneficial for you.
Okay. Yeah, no problem. So originally, like kind of what I had in mind yesterday, when I was, well, before I, whatever, was I was going to get a gauge for kind of what everyone's kind of trading experience was. And you mentioned yesterday you'd had a little experience trading options in the past, and so for you, it's not a super new thing. I just didn't know what everyone else's experience was, if they had ever traded. I mean, outside of say maybe using Robinhood, and then there's some people that maybe haven't even done that. And so I always like to try to gauge kind of where everyone's at, because I have a tendency of talking it like, you know, I try not to talk it like like whatever like my level of knowledge is, because I never want to assume what everyone else's is. So I think what we'll do actually is let's cover options today actually, so we can go through that trade. I didn't have a chance to do that Zoom recording yesterday for some reason. My options chain wasn't working yesterday. So I think what we'll do is we'll go through just real quick how to do the option side, and then I can go through some charting. So we are right now on my screen. Actually, that works because right now on my screen we have the options chain up. So this is what's called an options chain for people that don't know, and this is the chain for Charles Schwab. So this is the company that Bo had called out yesterday in his alert. And so
before you explain that, how does somebody get to where you're at? Is this a website or is this on the trading platform?
Sure thing. So this is on a platform called TradeStation. So there's a bunch of different platforms, and everyone's are brokers, and everyone's broker is going to be it's going to be different. There's going to be different criteria that people would choose for why they would go with one broker over another. For me, I went with TradeStation because they have lower execution fees, basically.
Order filled.
Oh, good. So that was actually a simulated order that I put in to close this position out. But so that's what I went with TradeStation for, is because that's one of the things when people look for a broker, they need to figure out like, okay, you have the trade itself, which a lot of brokers, they're trading information as far as their setup, and the data that they have access to are going to be pretty much the same. So there's going to be different formats for them in terms of the tools and usability, as far as what level of experience people need in order to really use those tools. For example, um, TD Ameritrade is probably a really popular one because it has a really, really advanced charting system platform. And it's actually not too bad as far as user friendliness either. But they tend to be more expensive in terms of order execution. So
Awesome.
one of the things, with trading is treating it like a business. So, in business, we try to lower whatever expenses we can because that cuts into our bottom line. So with trading, it's no different. I chose TradeStation because they've got some pretty low fees. I think it's like 75 cents per direction. So you're looking at about $1.50 to about $2 a trade in execution, regardless of the trade size. Whereas with TD Ameritrade, I'm not sure what the exact numbers are, but I mean it was like a few bucks, something like that per direction. So you'd be looking at $5 or $10 to open a trade, open and close, out a trade. If you're trading high dollar amounts, like like you're opening and closing multi-$1,000 trades, and yeah, you're not going to care about a few bucks here or there. But if you're scalping and you're only making 20, 30, $40 a trade, and that's how you make your income, is you just scalp a bunch of trades throughout the day. That's going to eat into your bottom line pretty quick. So that's how, that's one way you look for platform. So a lot of people, they'll use like say Robinhood, and I have to admit, from a usability standpoint, I mean, really, it doesn't get much easier than Robinhood. Robinhood, their layout is extremely user friendly. It's very intuitive. They don't have fees, like in the traditional sense, like how these trade brokers have fees. But on the downside of that is they have what's called payment for order flow, which is they don't try to place your order at the best possible price, because that's kind of what you pay broker fees for. You pay your broker fees, and the idea is that your broker will try to find you the best possible price for that execution. Robinhood, that's not what they're about. Their thing is, okay, well, we'll let you place the orders for free. We won't charge you per se for the trade, but we're not going to get you the best price either. And they'll take your trade data, and they will they'll sell that to other brokers, and then they'll use that trade data and they'll use that data to basically execute trades on their own based on the volume that's reported. So, and then there was that whole big stink about Robinhood and GameStop, a few years back when, GameStop stock was taking off because there was a big short squeeze being put on GameStop. And for those that don't know, a short squeeze is when a bunch of big institutional companies take out short positions, which means they're betting against a stock. They're basically putting in positions to basically lower the value of the stock. What Wall Street Bets, that group did, is they came in and they put a bunch of orders in the opposite direction. They bought a bunch of calls or long positions to try to bid up the price of the stock. Well, in order to make money on a short position, the stock's price has to go down. So if you have a bunch of people coming in and buying that stock and bidding the price up, well, every dollar that price of that stock goes up, the people on the downside direction of that trade, they're losing money. And with options, because it's a leveraged product, every dollar is is maximized. It multiplied out. So that's how these hedge funds lost billions of dollars, is because they were on the losing side. A couple of them actually did go out of business. It's not very common to hear about hedge funds going out of business. So, and so that's what Wall Street Bets did. Well, then of course Robinhood was in cahoots with one of those hedge funds that actually also had a short position. So Robinhood ended up stopping out people's ability to continue bidding up the price of the stock. in other words, they prevented people's Wall Street bets and all the other people's ability to continue maintaining the short squeeze. And what happens is, in order for that short squeeze, in order for it to be maintained, new orders have to continue be put into that. People have to continue bidding up the price of that stock. But if you prevent people's ability to be able to continue bidding up the price of the stock, eventually what will happen is that the value of the stock will go down, and it will give relief to those big hedge funds, which is exactly what happened in the Robinhood GameStop scandal. Is the stock had gone from a price of somewhere in the low teens up to over $400. So you imagine if you're a hedge fund and you had entered a short position at, say 14 or 15 bucks, and these Wall Street bets punks come in and bid the price up to $400.
Oh, wow.
You're gonna be hurting pretty bad because you're on the losing end of that trade. And then all of a sudden, Robinhood, the app that everyone's using because of how popular it was at the time, because it was new and it was supposed to be democratize finance, so everyone kind of trusted it because it was founded by these hip young kids who everyone thought, oh, they totally get us, and then come to find out they were just in bed with these hedge funds. And yeah, so. But don't worry, Wall Street Bets kind of got them back because they only got their big raises when they launched their IPO of Robinhood. They only got their big raises if the stock price reached a certain threshold within a certain amount of time, and Robinhood stock never reached that threshold. So they didn't. So the two founders of Robinhood never got their two really big fat bonuses. They still made it.
Very interesting.
Yeah. So kind of a, not really a happy ending, but a little bit of satisfaction.
A little sweet revenge.
Yeah. So as far as we're using TradeStation here. Like I said, everyone's choice of platform is going to be different. But for me, for how I got, how I get to, or how I would get to my options chain from, like, say, like my TradeStation home. And so this is like my TradeStation home. Everyone's is going to look different. Some will have, like I said, TD Ameritrade. Some will use Robinhood. I don't have any ill will towards anyone that uses Robinhood, and it's something I actually recommend if people don't really have a lot of experience trading options, because it is a good way to get your feet wet, because of how easy it is to use, and the fact that it doesn't have fees. You may not get the best price, but basically the price you see is the price you get, basically.
Okay.
So there is that. But for me, it was just a matter of I just go up to apps, and then I go to Option Station Pro, and that's how I get to it on TradeStation. And so everyone's is going to be different. That's kind of the challenging part about teaching something like this, is everyone is going to choose a broker based on, again, ease of use for themselves, based on if fees matter, things like that. But I would choose that app, and it would pull up this options chain here. And everyone's options chain is going to look pretty similar to this one. They're all kind of going to look pretty close to this, because what an options chain comprises of is you have obviously the ticker for the symbol of the stock that you're looking to trade. So in this case was Schwab, which if you saw in the alert that Bo had sent out, he sent out like a $sign and then kind of the four letters.
Yeah.
That's a TD Ameritrade way of typing a ticker. So for me, I just had to type in the four letters. Everyone's, again, it's going to be a little bit different in how you enter the ticker and pull up the options chain information. Let's see, can I mute? I'm going to mute. I think Discord keeps going off for some reason. It's like I started getting all these like spam messages. It's like everyone started. It's like I never got messages on Discord, and then all of a sudden it was. You know what? I'm just gonna close Discord for now. I don't need it up. I think. So, yeah, so everyone's options change, like pretty much the same. It's the ticker. The chain itself is comprised of these dates here. These dates are all the expiration dates that exist for this ticker within this chain. Now, if you know, we were just getting to this page, it would look something like this. We would have this list of dates. So, you know, when we're looking at, say, Bo's trade, he'd said, okay, the expiration date was going to be May 19th, which is this. We just locate that one here. We note that that's 29 days out, so about a month out expiration, which is good. And I mentioned in one of the posts in Discord that, you know, when in options you pay for time. That's a key characteristic of options. It's unlike that with other things. If you're trading just strictly OTC, like straight directional trades, meaning you're just buying and selling that stock as itself, you don't have to worry about time because time isn't a factor. You're buying and holding the stock, and you own that stock. With a contract, though, contract just gives you the right to buy or sell that commodity. But again, like any other contract, there's going to be a date attached to it. So with this, the expiration date of the contract basically means that's the date by which the contract, you know, basically has to be executed, or that's the expiration of the contract. Meaning after that date, the contract's no longer valid. So what a contract does is it gives you the right to buy or sell that stock by that date at a certain price. So that's the one component of a contract. The second component is the strike price. So strike price is right here in the middle. If you're looking at the chain, it should be labeled here, but it's usually right in the middle. Right in the middle here is you'll find the strike price, and all the strike price is basically the date that if you're buying an options contract, this is the date by which the value of the stock has to be not just at but above if you're buying a long position, right? So if you're buying a strike at $55, you want the value of the stock to be above $55. So even if it's $55.50 per share, and you have a 55 strike on the contract, that's fine because you're still that contract is still going to have value because the stock's worth $55.50, but you have a contract that lets people buy stock at $55 if they chose to execute it. Well, great. So what that contract means is, oh, I can buy the stock at a discount because the stock's currently $55.50, but this contract here says I can buy it for 55. Awesome. And so you wanted to be as much, every bit more in terms of value above that strike price that the stock gets. It's going to increase the value of that contract. Now, bear in mind though that that comes in the other factor, which is the time decay piece. So when I say you pay for time with options contract, you have this other component, and that's a time decay component. So the closer we get to this May 19th date, the crazier this price is going to get as far as the pricing for these options contracts. So, for example, this year, 55 strike, we see that the call that Bo had made yesterday is $2.33. So we can see that the price of the contract has gone up 6 cents. Well, it's ranging a little bit now, but it's about 3 to 6 cents now. Which comes out to about $4 to $6. So I mean, not a huge price difference in terms of, if we were to buy this contract today, right? You're paying about $6 more, which is not too bad. But let's say that it was, instead of being April 20th, it was like May 13th or something, or sometime out in the future. And let's say that we were much closer to this 55 strike price. You would be seeing the price of this option swing a lot more wildly. It would be moving up and down because it would be a lot more subject to changes in price. You would be seeing the value of the options contract. It'd be a lot harder to increase because as you get closer to an expiration, that time decay starts to eat away at the value of that options contract. And so basically when you're buying a directional like Bo does, the great challenge of buying directionals is there has to be a certain amount of momentum behind the movement of the stock. If the stock isn't increasing in price fast enough to keep up with the decay of price of the options contract, you're going to start to see the value of that contract start to go down. And so that's why buying a directional play can be a little bit risky versus say a multi-leg like an iron condor, which has a component built into it as part of one of its legs. And again, I don't want to get too into the weeds with options contracts, but it has a component built into it that helps to offset the time decay factor as part of how those are built. But directional plays are the easiest to execute. And again, since we're following somebody who's definitely very experienced, it's gives us a lot of confidence. So
Does he only do directional?
yeah, as far as I can tell, he only does directional plays, which is good for a lot of people who are just starting out. If you were throwing in a few multi-leg, a bit more complex options plays, even somebody like myself who actually, and other people have a little bit of experience with options, it's I don't really like doing multi-legs, to be honest. There are a lot of them are safer, but they're really easy to mess up if you do them wrong. So directional is pretty much what you see is what you get. So for example, I'll kind of show how that works. So let's say let's just say I decided to buy this contract, right? Well, for me, you have two sides. You have the strike price, and then you have two sides to this, right? This side is your calls. You see at the top here, your calls. This side your puts. Call is when your everything's going off now. Your calls are basically if you're going long on a call, you would be buying on the hope that the stock price was going up. If you're buying on the put side, you were hoping the price of the stock goes down. You make money when the price goes down. On the put side, you make money when the price goes up on the call side. So for directional perspective, we're gonna be, when we're buying calls, we're buying on the left side. Now, if you were to say he was buying a put, meaning he anticipates the price of Schwab to go down, then we would be looking at the left on the right side of things to be buying. Buying calls or puts, it's basically the same kind of thing. Really, all there is just knowing what you think the price is going to do.
Yeah.
There's no greater risk in buying a call than a put. Now, there is greater risk if you're selling premium, because it's selling premium, and I won't even get too far into that. But basically, with selling premium, your potential for loss is basically unlimited. But won't get too far into that. So for the purposes of this, we're focusing on the call side. We found our strike, we found our expirations. We already got basically two kind of components to it. So for this, all I do is I just click on the satisfied price because we're buying a call, so we're buying on the ask side. For this blue section here. What that does is it will open up the trade window at the bottom. So we know we're on the buy side because we're buying the call. There's a couple things to this. There's not too much. You have to really change in this. But some things to keep in mind. So one thing, of course, is going to be your quantity. And I mentioned yesterday, you want to make sure that you're position sizing correctly. So each of these contracts, right, as of the price that we have right now, we'll just go with this 234 price, is $234, right? So that's how much it is, because a contract is the right to buy or sell 100 shares of that stock. So you have to remember that this 234 price is the price per share, basically. So you have 100 shares to a contract. So you have to multiply this price out by the number of shares in the contract. So it's $234. Now, how you position size is, you look at your account size. If you've got a $10,000 account size, you might be able to afford a greater position. You might be able to get, say, like five of these contracts comes out to this $1,170. Well, your account may be able to absorb that, because you got to remember that with options, especially, not so much when you're buying OTC stock, but with options, the price of the options contract, by expiration, if it doesn't move the way that you want it to, will ultimately end up being worth nothing, being worthless.
Yep.
So, when you get into an options trade, and this is why, especially with options, you have to almost treat the funds that you're putting into the trade as lost funds, as though you were taking money and tossing it down a garbage chute. And I hate to use it like that, but almost in all trading, you have to basically have this mindset that the money you're putting in, it very well be lost capital. And you do that for a number of reasons, but the main reason is to avoid emotional attachment to the outcome.
Yeah, I like that.
Yeah, because if you're emotionally attached to a trade, you're gonna make decisions on managing that trade. They're gonna be based on emotion, not on logic. And so when people see, for example, in options, especially, you'll see the value of the options of this open PL down here, profit and loss. You'll see that number swing up and down, into the red, into the green, into the red, into the green. And if you're, emotionally attached to the trade, that's going to cause you a great amount of distress seeing that. And you will make decisions that are not based on logic and good trading practice. You will make decisions based on, your emotional attachment to the outcome. Hold on, grab me a quick drink of water. So this is the part where in options, particularly. Now there's a couple of ways, you can manage position sizing in options. Obviously with Bo's directional plays, we'll be looking at the strike price on the expiration that he provides. And then we can control the number of contracts that we decide to purchase. You could purchase one, and then that's your risk. Okay, it says running out of time, whatever. And that's your risk. Your risk is 234. Meaning if this contract went to zero, that's all you're out. And when I say that's all, I don't want to make light of the fact that to some people that wouldn't be a lot of money. That's just the max you can lose for this contract. Now, I mean, you could say, okay, you know what? I want to go all in because this guy knows what he's doing, and I'm gonna go in, this amount because I mean, this is Bo we're talking about. He's got 100% win rate. You know what? Screw it. Let's just go. Look, let's just go for the moon here. Okay, yeah, you could do that. You could say, okay, I want 50 contracts, and I'm gonna put, my risk is 11,000, but this guy can't lose, so I'm gonna make like 100 grand on this trade. You say that, but this could be that one trade he loses where he's like, well, I still have a 99% win rate for the year, but oh, too bad I lost this one. Well, to him, he's not putting, he might be putting in that amount, but he's got, lots of money, lots more to work with. That may be your children's, retirement account or college fund. And now you've got some hard explaining to your partner as to why wasted all their money on one trade. So position sizing is inherently important. because you want to make sure that you are positioning, you are creating a position that is, obviously in trading, there's really never going to be any perfect a level of comfort, but something you can live with, right? Capital you could live without if for some reason you lost it all, and that's really what it comes down to. If you lost the $237, that sucks. But you know what? I'm just gonna, I'll move on to the next thing.
Do it again. Yeah, exactly.
And then that's what it is with trading. So for me, it would be I just buy one contract, 234. Me, limit price. If you're trying to get a better, like for example, you think price of this contract is going to dip back down to this 234. Like for example, you see how it's fluctuating. You think that there's a chance it might dip back down to this level. You want to get a little bit of a better price. You do what's called a limit order, and basically you're just trying to I don't know what to exactly compare it to. I guess it's kind of like eBay, right? Where it's kind of like you're just trying to get that best price. Whereas a market order is the buy it now button. You're just trying to get into the trade. You do so. Market execution, that's just I want in now. I'm gonna take it at whatever price I get filled at. And so like for me, I don't really play with limit order very much because I'm kind of more of a, you know what, I don't want to play with these fluctuations. I just want into the price at whatever price I get filled at. So once you have your quantity, you choose your more market order type, you realize what your max loss is. Now remember, your max profit's infinity. Now is it likely going to go to infinity? Probably not. But notice that your max loss is capped, but your max profit is not. So that's that's the thing to note when you're buying directional plays. When you're buying them, buying directional plays. Whether you're buying a put or buying, puts, your profits limited as far as, but your loss is limited too. But anyways, so
But you can sell you can sell at any point. So even though it's max profit, it's not like you're not limited to holding the option for any length of time, right?
no, no.
Okay.
The only time factor that comes into play is the expiration date. So the
You're right.
contract
Okay.
will only have value really through that expiration date. So yeah, so I mean, this profit could go up to whatever amount within that time frame, but you have the option to sell that contract to basically close it out for whatever profit or loss, because you could be at loss at that point. But between now and that time, and you have control over basically how much profit you want to capture or how much loss you want to absorb. And that's going to be completely up to you. If this contract goes sideways for some reason, and your max loss is 235, but let's say this contract goes into the red, $20, and you're like, you know what, I don't really, $20 is the most I really want to take a loss on. You close it out, you take a $20 loss. Doesn't mean you have to take that $235 loss. You could take much less, but that's up to
Okay.
you.
Gotcha.
Each your little recap here tells you, would you like to place this order? That you acknowledge your loss, your max profits. That sure, why not?
Order filled.
And your order gets filled, you get a confirmation. Now here's the thing that TradeStation I don't like, and so if you're looking to trade simulated paper trade, which I highly recommend doing if you're not too new to it, for some reason TradeStation's paper trading is all messed up, because there's no way I just filled a trade for a single directional play and my P&L is positive 239. There's no way. So their paper trading is all kinds of messed up. I just used it just for the purposes of doing a demonstration. So if you're new in your paper trading, which I highly recommend you doing, TD Ameritrade has a really great paper trading platform. So I highly recommend just opening a TD Ameritrade account, creating a simulated trading account in TD Ameritrade, and then practicing with that. For the purposes of these bow plays, there's only, he only throws out one every so often. You could totally just download Robinhood, and you could totally just buy the trade from Robinhood. It's real easy to do. You don't have to mess around with these desktop-based platforms if you don't want to. If you want to, trade options more regularly, and you're looking to do it like you know, yeah, I'll take the bow play every so often, but you know what? I also want to trade it for myself. Then, you know, you might want to, you're going to want to get one of these brokers where you can get a more attractive rate. If we were using TradeStation on a live, in a live environment, then yeah, this P&L would be more accurate and we would have it. But again, for me, I just track for TradeStation for simulated accounts. Since I know the P&L for whatever reason is all messed up, I just trade the value, or I just trade the P&L for myself. So I just go to manage trade. I can see what I got into the trade at, so what my fill price was. So I got filled at 241 here. So don't pay attention to this. This is I was messing with this. So this I got filled at this 241 price. And I can go back to the options chain and I can look at what the price is at now. And it's a 254. Okay. So the difference between this 41 and this 54 is 13 cents. So my option is at $13 per contract that I have. And so I just manually track it that way in TradeStation. That's how I would do it. So that's executing options contract. Really didn't even get into any charting or anything like that.
No, I think that's really helpful for the people who want to just take and execute the bow trades. So that's super helpful. You've given like tons of options for different trading platforms and how to read the charts, or not the charts, but how to read like the strike price and stuff.
Yeah.
And so let's do this, because I really like this video for those who just want to learn how to get in and out of Bow's trades. And then if you want, we can do a separate video on chart reading if you want to do that.
Yeah, we could. Yeah, and that one, you know, we can do chart reading anytime. We don't have to do it right at market open. We didn't even have to do this one right at market open technically because, you know, nice thing about options, you know, you can only trade. So again, the reason we did it at market open, for one, you're gonna have the greatest volatility at market open. So notice the price of the options contract since we got onto this video, it's jumped up what 20 some odd cents, so about $20 since we started. And so market open has the greatest volatility. So 6:30 to about 7:30 is when you're going to see, and that's Pacific Standard Time. Sorry for everyone else. Sorry, I can't do the Central and Mountain in my head right now. But market open on the East Coast is 9:30 Eastern. So for where everyone else is, whether they're on Mountain or Central or whatever, you know, just remember that the New York session opens at 9:30 a.m. and the greatest volatility is between 9:30 and 10:30. That's when you're going to have the greatest amount of movement. You'll have movement throughout the trading day because the markets are open through 4 p.m. their time. Like I said, I'm trying to do the conversion in my head because it's 1 p.m. my time. And so you'll have movement between then, but there's periods